When you have so many projects and a single investor might be part of 15 different deals, how do you manage their updates? 15 emails every month? How do you manage the distributions? Is there an easy way to consolidate the updates for the investors and their quarterly distributions that you send them? And my answer to this is, I recently did an Ask Me Anything inside of my private real estate community. It's on Facebook, and we have about 500 members. They're all interacting, doing deals, communicating with each other. If you want to learn more about the real estate community, visit sweatystartup.com/REC, as in real estate community. And you can get in there and check it out with a free trial. But I got a lot of questions. I'm going to answer a couple of them right here on the podcast because I think that they are very good questions. I said, Nick, for deal flow, what outreach strategy to owners of real estate do you find works best? Letters, emails, calls, or all of the above? And we obviously try to do all of that. We send some emails, we cold call, and we send letters, postcards. But most deals have originated from cold calling. So if you're looking to find deals, find self-storage deals, this sounds crazy and too easy and hard and not that fun, but the best way is to pick up the phone and call owners and do your best to talk them into selling their property to you and figure out what the property's worth. And if you're interested in storage, we found that 100 to 125 times revenue on a monthly basis is a reasonable asking price, and then it's worth digging in further, meaning underwriting it and putting pen to paper and running your Excel models. But if a property's doing 10 grand a month and they want $1 million, it's likely a buy. It's likely a pretty good deal. I don't know for sure. You need to figure out property taxes, occupancy, upside, competitors, all these other things. And insurance, obviously, could be in a flood zone, whatever, but it could be pretty good. And if you need help underwriting a deal, I'll give another quick shameless plug. If you need help underwriting a deal, send me an email or visit sweatystartup.com/storage. That talks about my self-storage consulting. If you have a deal, a seller that wants to sell their property, you don't know what quite to offer, what it's worth to you, I get on the phone for an hour. I get on a Zoom call. Actually, it's recorded. I get on there for an hour with you, run through all the models, figure out what it's worth, underwrite it, and send you away with the tools to look at it. Got another good question. What dollar amount was your first raise? Meaning I'm raising money for my first deal. And how did you structure it? Now, my first raise in Ithaca, New York was a unique deal. And I didn't know anything about real estate private equity. This was way back in 2015. I was running around trying to raise money. I didn't know how real estate worked. And we were just trying to get it done. So the total dollar amount was about $500K. We put in $250K of our own money and then a little bit more. We had about $500K sitting aside of our own cash. We raised $500K of outside capital. And how did we structure it? If I were doing my first deal today, I would structure it on probably a 7 or 8% preferred return and 35% promote, maybe a 30% promote. If it's a really good deal, maybe a 40% promote. But in this market, I would definitely ease off that promote, meaning the percentage of the upside beyond that preferred return that you get. And if you don't know what I'm talking about, go to the first few episodes of the Nick Huber Show. In the first 10, I talk about the real estate private equity, how you raise money. There's one episode on that. There's one on the terms that you need to know. Listen to those, and you can learn what a preferred return is and what a promote. But on my first deal, we did it basically as if it was unlevered, meaning if we're going to build a building, we built it for $2.4 million, and you put in $240,000, you got 10% of the deal, meaning unlevered, how much cash is needed to buy this property? No debt, no bank debt. If it's $1 million, you put in $100,000, you get 10%. And the bank debt, I personally guaranteed the bank debt, and I paid the bank debt myself out of my portion of the cash flows. And the cash flows were high enough. I mean, this thing's spitting off 25% cash on cash return now for these investors, unlevered on that $2.4 million. Last quarter, we sent them 24% return on their initial investment on a quarterly or an annualized basis. But it was a funky way to do it. I would never recommend doing it on that structure now, A, because deals aren't good enough to do that structure and make it make sense for LPs, and B, because it's not standard. But we didn't know what we were doing. We were just figuring it out as we went. I made the packet and went around and raised the money. And that's that. So I got another question. Are you a buyer in this market? meaning with interest rates going up and pricing staying basically the same, are you buying right now in the macroeconomic environment? And the answer is yes, we're always buying. My goal is to build a scalable, sustainable, long-term real estate private equity company. And if you're going to do that, you have to be able to buy real estate in any market. And so what we've done recently is we've de-risked. We've gone down to 50% leverage, a lot more equity, and we've been really, really picky about what we're buying. 99 out of 100 deals we're missing out on right now. We're passing on almost everything that's on market from brokers. And frankly, we're just not buying that much stuff because price has not come down to reflect the current change in the economic environment, meaning rates are higher. Obviously, there are many, many buyers that don't think rates are going to be high for very long because they are still buying at old prices, thinking that rates eventually going to get there. Are they right? I don't know. I'm not smart enough to know, but I'm not willing to take this risk. I looked at a deal outside of Miami. It was a industrial deal that was sent by a sponsor. They were spending $35 million to build a warehouse. They were building it to a 4.75% yield to cost, total cost on the development once they fill it up and lease it, which is another question mark. You got to build it, then you got to lease it, and then it's a 4.75% yield to cost. And they were doing it all with Wall Street Journal Prime plus 50 basis points. Well, Wall Street Journal Prime is now 5.25%, meaning they're way, way, way underwater now. They're 65% levered and they're hemorrhaging money. And they're already looking for bank debt and the thing's half built. That's a tremendous problem, high risk. So what we've done is, okay, of course, we're still floating some debt because it makes sense to float debt at acquisition in a lot of our deals with the flexibility we need and the cash flow that we have on hand and the value add strategy and the refi on the quick horizon. But we just need the deal to be better. So am I a buyer in this market? Yes. Do we have deals under contract? Yes. We have a $9 million deal in Virginia under contract. We have a $2 million deal in Florida that's about to close. We have a $2 million deal in Mississippi that's about to close. We have one more that I can't remember exactly where it is. Just blanking on it right now, but it's under contract as well recently. So yes, we're still buyers, but we are spending a ton of money on deal flow right now. We have 4 full-time acquisitions folks. We're underwriting a ton of deals. And yeah, that's where we're at. So the short answer, yes, I'm a buyer. The long answer, no. I'm not, buying everything. That's for sure. I'm not as aggressive as I was. Our offer price is much lower and we're still able to find some deals. It's just harder. So another question, best method to find boots on the ground workers, meaning to sweep units, help manage our properties. And how do you structure their pay? Is it per hour or is it flat rate? And he's he's referring to my self-storage portfolio. How do I manage my self-storage portfolio? Because as you know, we have over 50 properties in many states, many, many miles apart. And we have a remote call center in the Philippines. We have operations folks in Colombia, and we have 50 full-time employees at our company. How do we structure the pay for the individual contractors that are on the ground, not full-time? They're just the ones out there sweeping units or, putting on overlocks or helping us manage an auction or whatever else. And the answer is we pay by the hour, $20, $30, $40 an hour, depending on the task and the skill level. And one of the best unique methods that we've found to find these people is calling a Mexican restaurant and asking if anybody's looking for work that they might know. And if you can speak Spanish, which our Colombian workers do, you can talk to the folks on the ground and say, hey, if you know anybody looking for extra work, it's not full-time, but we're paying blank per hour, and let us know if you know of anybody. That's been a good method. But a lot of it is Craigslist ads, Facebook ads, Indeed ads. I mean, we're literally doing everything we can to try to find folks to help. We've actually even emailed customers that are staying and said, if anybody knows anybody looking for part-time work, our company's hiring. And that's actually been a pretty good way to find help on the ground. Another question. When you have so many projects and a single investor might be part of 15 different deals, how do you manage their updates? 15 emails every month? How do you manage the distributions? Is there an easy way to consolidate the updates for the investors and their quarterly distributions that you send them? And my answer to this is Juniper Square. It's a software that we use. They sponsor this show. You hear me talk about them every week. But without Juniper Square, we have 4 full-time employees on our capital raising and capital management team. They're in charge of, overseeing the distributions, making sure everybody gets their tax returns, and keeping basically 250 investors, limited partners, organized and giving them everything they need and answering all the questions. Without Juniper Square, we would have 8 or 10 employees. We pay Juniper Square less than $10,000 a month or a year, and the value that we get is incredible. I mean, we can send the update emails with attachments. They're all organized right in Juniper. We do it in Juniper. One click of the button, they go to all emails. Responses are organized. And then sending the distributions and investors being able to log in and track their distributions. It is a powerhouse. It's unbelievable. And it's the only way that we are able to organize 250 investors and all the work that goes into that. Another question. How are you changing your underwriting to adjust to market conditions? And I kind of touched on it. Somebody asked, am I a buyer in this market? And the answer is yes, I'm a buyer, but my pricing expectations have gone down. We're willing to pay less for the same storage today than we were 6 months ago. But what in particular am I doing in my underwriting to adjust for the market conditions? And it's pretty simple. We're underwriting right now a 6.5% interest rate, meaning the debt that we were able to get at 3.75 6 months ago is now 6.5%. So that huge hurt, puts a huge hurt on yield when you're 50 or 60% leveraged. And we're underwriting a 6% loan or 6.5% loan at refinance. And then exit cap, meaning what cap rate are we going to sell our property at? We're underwriting, instead of a 5, we're underwriting a 6 cap now for exit. So my underwriting is vastly different. We're able to pay less for storage now than we were 6 months ago. Are other investors in the same boat? They should be. I mean, these are real. This is where we are right now with interest rates. And unless you're willing to gamble that they're going to go back down, you need to be underwriting higher interest rates, meaning you can pay less for the same cash on cash. What's this doing to our expectations? We still underrate internally to a 20 IRR, water it down to a 15 IRR before we send to LPs. And cash on cash year one is getting crushed by these interest rates. But investors are willing to see past that and into the long-term gain if, the market changes and things get better, or just we operate it really well and the deal goes well. The upside's huge, but year one cash on cash is down 3, 4, 5% year one cash on cash. Whereas 6 months ago, it was 6, 7, 8% year one cash on cash. So last question here that I'm going to take. Do you have USA or overseas based acquisitions, folks? How did I find my acquisitions, folks? And these are the people that are cold calling owners, trying to get owners to buy or sell their self-storage facilities to us. These are American workers. They're some of the highest paid people at our company. And they are from our network of friends, family, and then we've found a couple through Twitter as well. But no, somebody from the Philippines or Colombia is not cold calling self-storage owners. I mean, these owners they have such a sharp bullshit meter. They have zero time to waste with anybody who's knocking their doors down. They get tons of calls from people who are selling their facilities. I don't see how somebody overseas who doesn't even understand the culture or how to have a educated conversation with these people about their town or their property or self-storage, or even just slightly off with an accent. Those things can really hurt your ability to build rapport with an owner. So we hire Americans. Thank you for listening to this episode of Sway Startup. As always, I appreciate that. And if you have a second, I could use a review on Apple Podcasts. So wherever you listen to this, leave a rating and a review. I would really appreciate it. Juniper Square, the sponsor of this show, recently conducted some research to help you understand what real estate investment managers are doing to build stronger relationships with their investors and earn more referrals to new investors. Their new special report includes data on topics such as what factors are the most important for building investment relationships today, how technology is being used to provide a competitive edge, and the one technology integration that is driving more repeat investors and more referrals. To download this for free, visit junipersquareresearch.com. Again, to get this report for free, visit junipersquareresearch.com. Before you go, we have a new sponsor of the show, recostseg.com. And if you bought a piece of real estate, you need to get a cost segregation study done. It's what allows you to get all that sweet, sweet bonus depreciation, and it's how real estate investors like me and many others pay almost nothing in taxes on an annual basis. You can cost seg a single-family rental, a short-term rental, or a large commercial property. recostseg.com is affordable and aggressive and super fast to turn them around. They've done 10 plus cost segs for me this year. They're going to do many more for me. Visit recostseg.com to learn more.